Chapter 1, Part 3. We're on slide 32, the basic accounting equation. You need to have complete understanding of this one. This is mathematical. Assets equal liability plus owner's equity. And what I mean by mathematical, you can say assets minus liabilities equals owner's equity, or assets minus owner's equity equal liabilities. You can turn this around. But this is the basic accounting equation. It fits to the balance sheet, and it is mathematically exact, literally down to the penny. What are we talking about here? Let me see. Oops. Assets. Assets are resources owned by a business. There are things of value usually carried out for the utilization of the business. And what these things are things like cash, accounts receivable. Accounts receivable is like when you sell to a customer and then he doesn't pay you right away and he owes you. For instance, you might use your telephone service and you use it for a month and then pay it at the end of the month. Inventories is things that you buy to make your product and then you sell it back to the consumer. Or if you're a retail store, you buy your products and that's what you sell to your customers. It's different than supplies. Supplies is what is the materials you use in your business, like your pens and papers and so forth. Furniture and fixtures, that's like your in your building and so forth. There could be also real estate, land, there's equipment, so there's a variety of assets, and this is what's owned by the business. Liabilities are claims. This is stuff that you owe. These are your debts and your obligations. And things like notes payable. A note payable is where you've actually written out a legal document. Accounts payable. This is maybe where you've received services or inventories from your vendors, and maybe you're going to pay them at a later date. Interest payables, like on interest on your notes, on your loans and so forth. Salaries payable is what you maybe pay, or wages payable to your employees. You don't pay them every day. You might pay them every 2 weeks or at the end of the month. Well, if your accounting period goes in the middle of that period, you have to record that liability. Unearned revenue, I want special focus on this because this confuses a lot of students. Unearned revenue means something that you've been paid in advance, but you have not done the work or supplied the product. Case in point, you're a fencing contractor. Someone pays you $1,500 in advance, but you're not going to do the job for 2 weeks. You're going to take that $1,500, you're going to record it as unearned revenue. Once you build the fence, you will then change it over to revenue. So it's a misnomer, and you got to be careful in the trickiness of these terms and vocabulary. Again, the vocabulary in accounting is very, very specific, and you have to pay special attention to that. Owner's equity, this is your claim on the total assets. And what I mean by that is you might own a car that you paid $5,000 for it, but you borrowed $4,000. Well, your claim on that is only $1,000, even though you own the car. It's entitled in your name, but the financial equity that you have in that car is only $1,000 because you owe $4,000. And the owner's equity consists of two parts. This is a little bit confusing for students. Paid in capital or contributed capital. Usually to start a business, owners have to put in money to get it started. And you always record that as paid in capital. Whereas retained earnings, every year a company hopefully makes profit. And it might keep some of that profit in the company, not just always pay it out to the owners. And that money that you keep in the company, especially if you're trying to grow the company, is called retained earnings. And you separate that from the paid in capital. And that retained earnings will be kept as long as that company's in business. For instance, if you look at Ford, and you look at that retained earnings, that could be what they've kept in the company since the beginning of time, since that company started over 100 years ago. The accounting equation on an expanded level, the expanded accounting equation is where we take the equity section and we break it out to 4 sections. We have owner capital contributed, owner withdrawals. That could be in the form of dividends or withdrawals by the single owners. And then we take the income statement, the revenue and expenses to get net income. And that's all four components of the equity section. And you're going to have to memorize this because in the second chapter, this is what you're going to be living with. Let's take some transactions, and this is going to show you the double entry component of accounting. For instance, we have in this account, this slide, an owner is going to start his business, so he deposits $30,000. Well, what you would record is $30,000 in cash, and then the other side of the equation, you would report $30,000 in the capital account or the equity account. And now you have a balanced transaction. Your assets equal your liability plus equity here. And we'll do a variety of transactions to demonstrate this. Here, you're buying supplies, maybe pens and paper and business cards, and you take $2,500 out of your checking account and you buy the supplies. Now, again, a supply is an asset, so you have a negative asset and then a positive asset, and so the equation stays balanced at the $30,000 equals the $30,000. And this will go on throughout a variety of transactions here. You have, again, they're taking cash, and now you're buying equipment. Equipment is another form of asset. And these assets can get quite extensive, as well as the liabilities. Again, here they're buying more supplies, but this time they bought the supplies, but they did it on accounts payable. That means they haven't paid for it yet. They're going to have to pay at some future date. So you record that as a liability. But you'll see at the bottom here that it still keeps in balance at that balance sheet. At any point in time, that balance sheet must balance. If not, you have a problem. Go back to go and find it. And again, I'm not going to go through all these. It's just going to record a variety of transactions to show you that thing, whereas the bottom back down in here will always stay balanced. It can change in value, but it must always balance out. Again, you'll see a variety of transactions here to demonstrate this. I want to point out in this one, here we have $1,900, yet we break it out because they might want to track different kind of revenue streams, one from consulting services versus maybe rental income. And the other word for revenues, by the way, I want to point out here is sales. Sometimes some companies will use one form of terminology and others will use another form. And that's one of the confusion parts of accounting. Not all companies use the same terminology. So you're going to have to get used to what, again, the textbook provides you, but it could be different than the real world. Again, this goes through a variety of transactions, and then it sums it up at the bottom here. But you'll notice that it always has to maintain an even balance between the assets plus the liabilities in the equity account. There are four financial statements. We are, in this class, going to focus on number 1 and number 3. And when we get to accounting 2, we'll bring in the statement of owner's equity and the statement of cash flow in greater detail. We will look at those other two statements, but it'll be on a lighter basis in accounting 1. And then an income statement. It describes a company's revenue and expenses for a certain period of time, usually a year, but it can be also for the month or for the quarter. And it's spread out over a period of time. Whereas number 3, the balance sheet, it describes a company's financial position, like how much cash you have, how much equipment you have, how much money you owe, and it shows it at a point in time. Notice the difference. The income statement is over a period of time, whereas the balance sheet is at a certain point in time. And that point in time will be identified in the title of the balance sheet. It'll say, for instance, December 31 or June 30th. The statement of owner's equity, it'll just break out the equity component of that balance sheet in greater detail. For instance, for corporations, there could be various classes of stock, for instance, preferred stock in different series of common stock and so forth, and it'll break that out in detail. And the statement of cash flow measures just that. It just measures cash, the actual cash going in and out of a company. There are many accounting transactions that do not involve cash. Maybe you bought supplies on credit. Maybe someone donated real estate for stock. So there can be many transactions that is reflected in the other financial statements that are non-cash basis. The statement of cash flow measures just cash. And it was the latest of statements that was entered, required by the SAB or for GAAP standards. I think it's only about 30 or 40 years old in its requirements. Here's an example of the income statement. Notice it says fast forward. I can already tell that this is a sole proprietorship. How? Because if it was an incorporation, it would say incorporated or corporation of some designation. If it was an LLC or partnership, it would say that. But here it just says fast forward. It tells me it's a sole proprietorship. Next is the income statement, and then it defines the period. This happens to be for a month end of this for the month of December. And notice that it shows all its revenues. There can be different revenue streams, as well as a variety of expenses, and then the net. In this case, the company made $4,400. Statement of owner's equity. In this case, it's very simple. There's one owner, and then you add that net income for that period of time, and maybe he took out some withdrawals. In this case, it was only $200. But notice it'll say also, it'll define in the title section what the statement is and for what period. The balance sheet, you're going to get very familiar with this throughout this term. Usually it's vertical assets, then liability and equity. Here they broke it up to match the accounting equation for you. But notice again, it says balance sheet, and this is for that period of time. This is for the ending day of December 31st. It'll list its assets, then the liabilities and equity. Notice they're in balance here. Statement of cash flows, we're going to get into this in much greater detail in Chapter 11 in Accounting 2, not in this class period. But again, it will just detail out how cash came into the company and how it left the company in detail. Also, there are other components of the annual report that companies report. There's the management discussion and analysis, notes to the financial statements, and the auditor's report. You will not study this until literally intermediate accounting. You will not even deal with this in Accounting 1 or in Accounting 2. But there are significant more financial information that is presented than just the basic financial statements. Again, there's international standards. I'm not going to go into detail. I think that should be more of an advanced accounting class. That's it for this section. I hope this helped, and I'll be recording Chapter 2 at a later date. Thank you.